To invest well, you should probably learn as much as you can from the finest investors. Peter Lynch of Fidelity falls well under this group. During his 13 years as money manager for Fidelity's Magellan Fund, the fund averaged a 29% annual return. During the same time period, between 1977 and 1990, the S&P 500 achieved less than half of that. Fortunately for us, an investment conference in 1997, Peter Lynch kindly detailed his investment technique. The video provides an educated and approachable introduction to building a solid financial portfolio. In this video, we'll go over some of the principles we learned from Lynch's interview. This covers what he searches for in investment prospects, where he should prospect, and how he should prospect. Number 1. Purchase good businesses at reasonable prices.
People buy this stuff. I mean, I buy stuff like Dunkin' Donuts and Stop and Shop and CVS and made money in all those. And Sallie Mae was just here, right before me. I mean, there was a stock I bought that they had a great name, it was Student Loan Marketing. I mean, who would ever buy anything like that? It was a great name. If you heard the story, I think 100 people heard the story. In fact, I had dinner last night with Al Lohr, Ned Fox, and Paul Carey. We're all in that roadshow in 1983. I think if 100 people looked at Sallie Mae, they would have bought it, but 100 people wouldn't look at it because imagine loaning money to students. Imagine doing anything with students. And it was a great story. It was simple, and no one looked at it. So that's the kind of stocks I like to buy. But I'm telling you, people don't do this. And I'm talking sophisticated people, unsophisticated people. They don't know what the company is, what's the story. And it's very important to know it because it doesn't always work, and you have to keep posted.
If you like the store, you'll probably like the stock. Peter Lynch, like other value-oriented investors, prefers to acquire stocks at affordable prices in firms with rising sales and earnings per share. Lynch claims that it is tough to lose money when investing in strong firms that trade at 3 to 6 times earnings. Finding inexpensive stocks generally entails looking for outstanding firms in underserved industries. Lynch prefers low-cost, low-leverage operators that shun boardroom excess and executive hierarchies. They reject corporate bureaucracy, provide excellent employee support, and carve up successful niches in frequently ignored sectors. Number 2. Avoid paying too much for progress.
I remember when Polaroid went from 140 to about 107. People said, if you ever get Polaroid under 100, you got to buy it. You just back up the truck, buy the stock. Stock you get to 110, then rally, fall 103, you go 112, go 105. They said, gets under 100. Buy Polaroid. Polaroid broke 100. People started buying it, and within 9 months, the stock was 18. I saw the same thing with Avon Products. So just saying, it's gone down this far. How much lower? I mean, it's crazy, but it can keep going. In fact, I tried this out. Kaiser Industries. I was a new analyst at Fidelity, and we were about to buy the biggest block ever at Kaiser Industries. The stock had gone from 29 to 17. We're about to buy the largest block ever in the history of the American Stock Exchange. We bought, 10 or 15 million shares. At 15 3/4, I said, my God, the stock's gone from 29 to 17. How much lower can it go? So we bought this enormous block at 15 3/4. So I called my mother and I said, Mom, I guess stock at Kaiser Industries, it's 10. So about 3 months later, I said, you ought to buy this. It's gone from 29 to 10. How much lower can it go?
Lynch's general approach is to hunt for stocks that trade at or below their profits growth rate. This may be viewed as a hurdle rate or margin of safety for picking equities with potential upside relative to their purchase price. He believes that if we can locate a 25% growth with a P/E ratio of 20 or less, we should purchase. If the firm is well positioned to handle industry downturns and has a lengthy runway for development, the tail becomes even more compelling. Any growth stock that sells at a price-to-earnings ratio of 40 or more, according to Peter Lynch, is usually in outlandish territory. However, he claims that a company with a high P/E ratio that grows rapidly will typically outperform a slow-growing company with a lower P/E ratio. Similarly, he emphasizes the importance of remaining wary of corporations that claim ghost earnings. Some businesses will claim phantom earnings as well as a result of acquisitions and asset reevaluations. As a result, using previous performance to evaluate companies might be inaccurate at times. Management teams and economic situations are subject to change. Number 3. Invest in a solid balance sheet.
So I said, let's check this again. The stock's 4. They own 45% of Kaiser Aluminum, They own 59% of Kaiser Steel. They own 38% of Kaiser Cement. They own all of Kaiser Electronics, all of Kaiser Broadcasting, which had 7 TV sets. They own Jeep. They had Kaiser Fiberglass. I said about Kaiser Sand and Gravel. They had a bunch of other Kaisers, and they had no debt. Now, in this room, because I know Freeman Billings is very interested in financial stocks, no one's ever gone bankrupt without any debt. Now, that would take a real, I think you have to give some kind of distinguished service award to somebody who did that. But they had no debt. I said, it's not going to go to zero. You know, I was wrong when I said it can't go below 15. So we hung on, and within 3 years, they gave out the shares in Kaiser Steel, gave out the shares in Kaiser Cement, gave out the shares in Kaiser Steel and Aluminum, and they sold off all the businesses. You got about $55 a share.
Lynch selects firms with strong balance sheets and promising potential that are not currently of attention to Wall Street. Given how dangerous excessive leverage can be in the worst of circumstances, he prefers balance sheets with at least twice as much equity as debt. If the debt is not due for several years and/or is not owing to banks, Lynch may offer some concessions. He also avoids balance statements with excessive inventories or receivables. This might be a good sign of postponed losses and profits overstatement. Significant accounts payable is acceptable if the corporation pays its invoices slowly and uses cash more efficiently. Number 4. Warren Buffett's method. It is probably more trustworthy to stick with a reliable and consistent investment vehicle rather than try to ride the next wave of success. He points out, for instance, that capital gains tax will harm the investor who makes too many switchovers. Lynch and Warren Buffett of Berkshire Hathaway, another renowned investor, have similar investment philosophies. The Warren Buffett Way by Robert Hagstrom explains how Buffett looks for businesses with reliable long-term economic prospects, solid balance sheets, trustworthy managers, and stock prices that are well below their intrinsic value estimates. Number 5. Fear beckons business opportunities.
These people have been through recessions, depressions, world wars. They've seen it all. There's a great expression in the textile industry. It's always darkest before pitch black. Now that's a good one to remember, because when business is terrible, it can get considerably terrible. It can get terrible to the power of 6. And I love those numbers on freight car deliveries. You ever watch, I love the show Jeopardy. You ever watch Jeopardy and people come out, they will know those numbers. Remember, they'll know the numbers. And they'll know, you know, what country Box took his first vacation in, and they'll know Phil Rizzuto's batting average and what his wife's first name was, and they'll know the stock symbols of Xerox before it was Haloid, or, you know, they know everything.
Those who favor bonds don't realize what they're missing. Lynch adds that over the long term, equities had outperformed bonds and cash deposits as of the time of writing, 1993. He claims that in order to succeed, you simply need to carefully consider your options and choose a small number of high-quality stocks. Of course, there is a lot more to it than that. Successful investors in particular avoid letting daily concerns dictate strategy or drive rash judgments. He claims that maintaining confidence in equities is essential. Daily news reports about the state of our economy are presented to us. Changes in interest rates, oil price stocks, trade conflicts, terrorist attacks, financial crises, environmental catastrophes, and economic recessions are a few frequent examples. Many people may overinvest in bonds, money markets, and savings accounts as a result of post-crisis shock. For instance, a 30-year Treasury bond is only secure if there are another 30 years of low inflation. Every bear market that causes a brief decline in earnings also presents an opportunity to purchase fantastic companies at deeply discounted prices relative to their intrinsic value. Number 6. Think of the larger picture. Focus on the even bigger picture when you're in despair about the big picture. If we simply pay attention to daily media, we could lose out on long-term chances. Without confidence in your ability to make sound financial decisions, you are more inclined to trust passing headlines and lose focus on your approach. If the quiet facts tell you differently about the industry's long-term prospects, it may be prudent to invest in the finest firms even while the news is getting worse rather than better. News regarding a company's difficulties in comparison to successful rivals is more damaging than bad news about the industry as a whole. These factors are the main drivers behind value investor Monish Pabrai's preference for searching for companies in temporarily troubled sectors, as he explains in his book, The Dando Investor. Number 7. Follow your gut while investing. Lynch thinks that developing a consistent investing habit has significant advantages. Having said that, he himself did not have a comprehensive investing plan. As he gained knowledge of the advantages of each opportunity, he preferred to switch between cases. It's crucial to notice that Lynch prioritizes the business here rather than the share price. He cares less about whether he is overweight or underweight in any certain industry and more about the subtleties of a company's growth and earnings narrative. Lynch is constantly searching for new businesses that are more cheap than his existing ones. Like Warren Buffett, he stays away from making investments in businesses he is unfamiliar with. Number 8. The King of Patience. The stock you already own might be the best one to buy. The once-upon-a-time Fidelity manager makes an effort to continue with businesses whose prospects are improving. In his words, pulling out the flowers and watering the weeds is not advised. He also advises readers not to feel pressed for time when it comes to purchasing shares. For instance, it might be beneficial to wait for distressed assets to reveal more information about their future. Lynch also thinks that it is smart to keep cash on hand if we are unable to locate good firms at reasonable costs. He proposes buying a tiny interest in our favorite pricey firms and increasing our commitment only during a significant sell-off as one approach to dealing with them. Number 9. Make a list of all your thoughts. Lynch carries a notepad with brief descriptions of business news he hears, along with his justifications for purchasing, avoiding, and selling any holdings. Otherwise, it becomes challenging to recall and look back on a company's history and decisions. Lynch adds that the quantity of stocks you hold influences how much time you spend on research. Lynch spends many hours annually monitoring each business, reviewing yearly and quarterly reports, as well as requesting frequent updates fall under this category. For a hobby investor with 5 or fewer companies in their portfolio, this is manageable. This may be a 9-to-5 employment for a small to medium-sized fund. In comparison, this might represent a 60 to 80 hour a week for a big fund with several assets. Number 10. Passing the exam in 90 seconds. Never put money into an idea you can't draw with a crayon. This is a brief, straightforward, yet important concept that really hit home with us. You should be able to explain why you are purchasing a stock in a firm in 90 seconds and simple terms if you want to invest in it. According to him, it's important to understand whether your stocks are fairly valued in relation to earnings, as well as how and why business earnings are likely to fluctuate. To determine whether a firm can weather unforeseen upswings or shocks, you need also be aware of its financial stability and debt load. According to Peter, there are no assurances or rules for investing. No matter how thoroughly you comprehend the business and its underlying narrative, you can never be confident that an investment will pay off. However, he thinks that with effort and consideration, one can make wise decisions with good odds. What's your own strategy for beating the street? We'd love to hear in the comments section.